Hello and welcome to Switzer TV. I'm Peter Switzer. And today we want to talk about the kind of stocks that should be in the core of your portfolio. Paul, how have you gone about selecting those stocks?
Yeah, we have labelled them cornerstone stocks, Peter. I think arguably sort of the best of the best in terms of what I would want to have as the bottom line in my portfolio. Yeah. We've looked at each of the 8 major sectors, Peter. We've taken one from each just to make sure we get a diversification, we get spread across the sectors. No energy, telco, utility, but we've got the 8 major sectors. And I'd say that in most of these cases, or in all these cases, the market will say these are blue chip, and that's in terms of things like liquidity, in terms of market expectations, in terms of how the market prices the stock as well, in terms of putting it a premium to its peers.
Yeah. Okay, let's go to the first one, is financials, and you've gone for CBA.
Well, I have gone for Commonwealth Bank. It is traded as a premium to its other 3 major bank peers. I think it has the best technology, Peter. It's number 1 or number 2 in each of its major markets, which is really important. Also, I think the leadership team is rated pretty highly. It has performed better over the last decade than the other major banks. So I think it is Commonwealth Bank. That's really the cornerstone stock.
And remember, this is like the core stock that you might hold. I personally hold the other banks because I think there's more upside in terms of share price because they've been beaten up, they've had improved leadership. But like Macquarie is another one that's not there.
Yeah,
but why didn't you select Macquarie?
We thought about Macquarie. It's probably a bit more in the investment banking category and probably just a little more volatile.
Yeah.
So that's why Commonwealth Bank is there. It's not to say there's anything wrong with Macquarie. I know a lot of us have Macquarie in our portfolio.
Yeah,
so
it's just not the core, is it? Let's go to the next one, materials.
Yeah, in the materials sector, which is, I've gone for BHP, and it's also the largest company in the materials sector. Look, it really has the best assets in terms of iron ore, copper, and petroleum. It's diversified. That's one of the reasons I like BHP.
Yeah.
Had a few missteps in around 2015-16 with the Samarco issue in Brazil. Seems to have got over that. Benefit also from commodity prices. It's more diversified than the Rios or Fortescues, and I think it's been pretty well led in the last decade or so.
Yeah, best of breed. Let's go to the healthcare sector, Paul.
Don't think you're going to get too many arguments about CSL, particularly as that share price, if I kept on going even longer, Peter, would be less than $1 in a sort of a like-for-like basis,
chart.
up over $300. No arguments in the market about CSL. It's the number 1 stock in healthcare. I think it's got to be a cornerstone in your portfolio.
Industrial, Transurban.
Yeah, this might surprise people because it's not actually an industrial. It doesn't make anything. Yeah. Of course, this is toll road operator Transurban, which rightly or wrongly, because it's sort of a transport company, gets classified as the industrials company. Just snuck into the top 10 companies in Australia by market capitalisation, which just shows you how powerful the business of being a toll road operator is. Yeah. They own about 80% of the toll roads in Sydney, Melbourne and Brisbane, and that stock just keeps on going up. Had a bit of a blip with the virus, but people have come back to toll roads, Peter.
Yeah, exactly right. Let's go to the next one, consumer discretionary.
Yeah, Wesfarmers, really due to the powerhouse of the Bunnings franchise, also Officeworks and Kmart has been right up there. Wesfarmers also has had a little bit of a misstep. It tried to Bunningize the UK and that didn't work, lost a lot of money on that venture. It has got out of its coal resources, which is probably a smart move. Got some other things in the industrials and safety area. It is still a conglomerate, but it's really Bunnings that really drives the Wesfarmers.
But they're also cashed up, Paul, and they are looking for opportunities.
Disposed of its coals business, and it is cashed up. So it may be priced a little bit to perfection, but I think you've got to say it has a pretty good track record, as that 10-year chart shows you.
Okay, real estate, and this surprised you in many ways, didn't it?
Well, not so much Goodman Group, but when I look back at the chart of Goodman Group over 10 years, I was pretty blown away, Peter, to see what had happened. They've obviously made a pretty smart move into provision of logistics or property to support the industrial and logistical side of the business, haven't they?
Yeah, without a doubt. They're linked to companies like Amazon. All the online businesses are using their warehouses because fulfillment has become particularly important, and especially since the coronavirus. I think this is a company that's really leveraged to the future of where retail is going, and a lot of it's going to be online.
And a lot of the other real estate trusts, particularly those exposed to the office sector, they're pretty challenged at the moment. So I think Goodman Group deserves to be up there, and that chart says everything.
Okay, let's go to consumer staples now.
Yeah, you could argue Woolworths. It had a misstep, particularly when had Masters and the Masters investment didn't work. It did change CEOs. It also had the supermarket wars, and it has shot back under the new CEO and done pretty well over the last 2 or 3 years. So I think Woolworths is still a better supermarket business than Coles. It's divesting its liquor business, which might be a good move for shareholders. So I think Woolworths is pretty well your benchmark sort of consumer staples company.
And a German rival called Coughlin was here, then went back home. So that makes me think the future is pretty good for Woolworths. Information technology, Paul?
Yeah, I guess we could have had a look at a company like Xero. Afterpay on the share price should look phenomenal. I actually prefer the Xero business, Peter, A, because it's been there longer, but also because I think the business is stickier, right? So Xero, of course, is the accounting software. Once you get it, very hard to get off it. You pay by subscription. Came out of New Zealand, now in Australia, done well in the UK and also in the US to some extent. So I think it's very good software. And of any of Australia's IT stocks, Xero is the one I'd have.
Yeah, and it fulfills the idea of a solid company with less stress. Afterpay could one day have a consumer credit challenge, who knows? But this one, I think, you're right. Absolutely.
So to summarise, Peter, financials, CBA, materials, BHP, healthcare, CSL, industrials, Transurban, Wesfarmers from consumer discretionary, Goodman Group from the real estate property sector, Woolworths from consumer staples and information technology. We've gone for Xero.
Yeah, and they are what we would call solid cornerstone stocks. But also, Paul, what I like about this list is if we do see a coronavirus second wave infection sell off of the stock market, these are the sort of companies I want to buy at lower prices for the future going forward. Thanks for joining us on Switzer TV.